Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at UOA Today. Unusual option activity. Certainly saw a bunch of option activity today. And number one on the list, Round Hill Memory ETF, a fairly new entry into kind of the AI space, aptly named DRAM with the stock symbol. So, going to take a look at a couple of trades to capture IV at extremes, one leaning bullishly with a plethora of the call buyers out there, and the second one just looking to capture vol outright with plenty of cushion. So let's jump in and take a look, shall we? First of all, here's a scanner from today. Number one on the list, Round Hill Memory ETF DRAM, right? You can see over 500,000 option contracts traded. Certainly well more than the less than 150,000 normal volume, 3.5 times the volume. More importantly, IV at the highest level we have ever seen. A fairly new one, but we'll take a look at the IV chart in a second. Certainly, IV has picked up dramatically here. And the Round Hill ETF basically comprised of Micron and SK Hynix of South Korea, right? Storage and memory sort of chip name out there. They comprise well over 50% of it, along with Samsung, right, number three. So certainly these felt some pressure today. They had been the absolute darlings in the market before then, finally had some pushback. And the IV, as we said, that scanner showing IV at the 100th percentile. Here's a quick look at it, right? I went to the 120-day IV, a little bit longer term. You can see IV trading at by far the highest level we have seen basically since it came to inception in April. So this has only been around for a few months, right? You can see IV jumped, right, from Monday to Tuesday's close across the entire term structure vol. Here's a look back, right? Basically for a month, you can see in late May, excuse me, IV generally under 90, now poking its head well over 100. So IV spiking, no question about it. Here it is, 100 percentile on a different look, right, to the IV 30 rank, and elevated to say the least. You can't get any more elevated. Here's the November series that we're going to be looking at, right? We saw a 4 vol point jump as well. I pulled off the IV chart basically for the entire history of a 50 delta kind of at the money 120-day call. You can see IV once again exploding. We have that brief run up, right, which actually signaled kind of a short-term top in DRAM back then, but we're seeing IV get to the highest level we have seen. You can see how quickly that reverted. That's what we're looking to have happen. The nice thing about IV, it makes option prices more expensive, right? That's another way to say the price of the option is the IV. So it sets up a couple different trade ideas to basically sell these expensive options. One is a simple covered call trade, right? So I pulled off from June the 15th, right? The stock at 71.07, and we can take a look on the chart going back to this date here, right, when the stock was virtually at the same price, actually a little bit higher, right? Closed at 71.07. Today we're looking at 69.22, so the stock a little bit lower, but the November 80 call, which had 157 days expiration, right, was priced somewhere just under 13 bucks, right? Trading at about an 85 IV, had a 53 delta on it, right? Even though it's out of the money, the IV was fairly high, so that upward drift rate, and a 5 theta, so basically saying every day, right, this option would be expected to lose about a nickel as a function of time. So you're going to drop a nickel just by holding it until November expiration. As we said, that option closed at 12.85 going back about a week. Fast forward to today's close, we can see the stock at 69.22, so lower versus our kind of comparative date a week ago at 71.07. But lo and behold, the option price actually much higher. now over 13 and a half. It was below 13 back then, now over 13 and a half, right? So the stock dropping, right, a couple bucks pretty much, and a week in time roughly passing, which is a negative, right? You have time decay, but yet the option actually closed higher. Why? Because of that huge jump in implied volatility, now at over 93. Back then it was barely over 85. So I kind of put two and two together here. So going back to June 15th, the stock or the ETF DRAM 7107. That November 80 call, right, was at 1285, had a 53 delta. So the buy right, buying the stock, selling that call, you'd be 47 deltas net long. The IV back then 85.40, and that buy right, simply buying the stock, selling the call, would have cost you 58.22. Fast forward to today's close, right? The stock was down $1.85, right? But yet the calls closed at 13.55. They went up 70 cents. So anytime you have the stock down and the calls up, probably not a bad idea to consider a covered call trade, buying what's down, selling what's up. And notice too, even with the stock dropping, the call delta actually went higher. Why? Because of that huge jump in implied volatility. So that buy right delta actually lowered by 1 to 46, right? All because that IV jumped over 8 vol points, or almost 10%, from roughly 85 to over 93. So you're able to get into the buy right $2.55 cheaper, buying the stock $1.85 lower, and selling the call, believe it or not, 70 cents higher. So the expected delta drop on that call, right? Because the delta on the call roughly 53 and a half over that time frame, right? Stock went down $1.85. So you'd expect the call price to drop about $1, right? A 50 delta with the stock down almost $2. You'd expect it to drop about $1. Theta waits for no one, right? Losing about 5.5 cents a day. You'd expect to lose about 44 cents, right, from time decay. So you'd expect the call to be lower by $1.43 and trading at about 11.40, right? It was trading at 12.85 minus $1.43, somewhere around 11.40. Yet we had the call actually go up in price, right? So our vol edge is $2.13. That's what you would kind of capture by selling this call now versus back then. So certainly doing a simple covered call trade, buying the stock cheaper, selling the call higher, makes a heck of a lot of sense to me. So you again would have expected a call to drop $1.43, but went up 70 cents, giving you that over $2 vol edge. Another trade to look at is a simple strangle trade. So I took the same kind of benchmark date going back to June 15th. And again, last time the kind of stock was here roughly a week ago. You can see that the November 100 call and $50 put sell strangle, selling both back then, trading just over 13 bucks. IV right around 85 or so. Fast forward to today's close, even with the stock dropping a few points, that sell strangle went up over 2 points. So it moved basically as much as the stock, right? Even though you were short, right, you would expect it to, kind of head a little bit lower, but not that much. But instead, because of the huge jump in IV, it actually exploded higher. So here's something to consider as well with a lot of cushion. So again, put the two together. So back on June 15th with the stock at 7107, that sell strangle, right, selling the November 100 call and $50 put, trading at about $13.10. The call delta was 38 back then, right? So you can see here, right? You can see also that the put delta a negative 18 back then as well, which would then put that sell strangle, if you sold it right, you'd be 20 deltas net short. The theta, 8 cents, so you'd expect to lose about 8 cents a day in theta. The IV, roughly just over 85, as we talked about before. Fast forward to today's close, stock dropped $1.85, right? Yet the strangle moved up more than the stock dropped, huh? moved up $2.05, makes no sense, right? Call delta, as we said, actually went up, and this is the 100 delta, 100 strike call, right? Went up by two, delta points, right, from 38 to 40. Put delta went down one delta, so you basically stayed the same, roughly about a minus 20 delta if you sold this, right? Theta increased because of that jump in IV, and the IV jumped, in this case, almost 10 vol points, or well over 11%. So doing the trade back then, right, you would have had the $100 strike price be about 41% out of the money, about 29 points of upside cushion with the stock at 71 roughly. The downside, the $50 put, 21 points of downside, or about 30%. Today, now you have more upside because the stock dropped almost 31 points, or almost 45%, still a healthy downside of almost 28% before the trade would get in trouble, before the strike price would kind of, cause some angst on it, right? So putting those together, your expected delta gain, right, on the trade. So if you sold it back here, right, at 13.10, and you would have been short 20 deltas, and you had the stock drop $1.85, you'd expect to have that sell strangle drop in price 38 cents. You'd also expect, with 8 days passing or so, right, and the theta of about 9 cents a day, right, you'd expect to make about 72 cents in theta. So you'd expect that sell strangle to drop $1.10 from 13.10 to about 12, but it actually went up $2.05, right, giving you a very nice vol edge of $3.15. So selling it now anywhere around 15, right, with plenty of upside and downside cushion, still selling the highest IV ever, and making money if the ETF drops in price because you're net short a few deltas, right? More importantly, you're looking for that big jump in IV just to level off here. As far as the margin, a very cheap one here, doing it one time, right, would only tie up about $1,000, $717.60. You always want to leave yourself some wiggle room. So we'll see how this one does. We'll give you an update, but this is another way to take advantage of that huge jump in IV, right? The biggest one on the board here. Capture the fact that the calls went up in price when they should have gone down. With the stock going down, the calls up certainly makes sense. Buy the stock cheaper, sell the calls more expensive, and selling the strangle that you would have expected to drop from 13.10 to about $12 even, right? Now at 15.15 with a $3 edge, plenty of upside and downside cushion, makes a lot of sense too. So until next time, as always, here's the good trading.